Forex. What is Forex and how does it work? Forex, also known as foreign exchange or FX trading, is the conversion of one currency into another. It is one of the most actively traded markets in the world, with an average daily trading volume of $5 trillion. Take a closer look at everything you'll need to know about Forex, including what it is, how you trade it and how leverage in Forex works. What is Forex trading? Forex, or foreign exchange, can be explained as a network of buyers and sellers, who transfer currency between each other at an agreed price. It is the means by which individuals, companies and central banks convert one currency into another. If you have ever traveled abroad, then it is likely you have made a Forex transaction. While a lot of foreign exchange is done for practical purposes, the vast majority of currency conversion is undertaken with the aim of earning a profit. The amount of currency converted every day can make price movements of some currencies extremely volatile. It is this volatility that can make Forex so attractive to traders, bringing about a greater chance of high profits, while also increasing the risk. How do currency markets work? Unlike shares or commodities, Forex trading does not take place on exchanges but directly between two parties, in an over-the-counter (OTC) market. The Forex market is run by a global network of banks, spread across 4 major Forex trading centers in different time zones: London, New York, Sydney, and Tokyo. Because there is no central location, you can trade Forex 24 hours a day. There are 3 different types of Forex market. Spot Forex market. The physical exchange of a currency pair, which takes place at the exact point the trade is settled, on the spot or within a short period of time. Forward Forex market. A contract is agreed to buy or sell a set amount of a currency at a specified price, to be settled at a set date in the future or within a range of future dates. Future Forex market. A contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a futures contract is legally binding. What is a base and quote currency? A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quote currency. Each currency in the pair is listed as a 3-letter code, which tends to be formed of 2 letters that stand for the region, and 1 standing for the currency itself. For example, pound sterling to US dollar is a currency pair that involves buying the Great British Pound and selling the US dollar. So in the example below, GBP is the base currency and USD is the quote currency. If pound sterling to US dollar is trading at 1.35361, then 1 pound is worth $1.35361. If the pound rises against the dollar, then a single pound will be worth more dollars and the pair's price will increase. If it drops, the pair's price will decrease. So if you think that the base currency in a pair is likely to strengthen against the quote currency, you can buy the pair, going long. If you think it will weaken, you can sell the pair, going short. See this diagram. GBP. Base currency, or the currency you are buying when you trade the Forex pair. USD quote currency, or the currency you are selling when you trade the Forex pair. To keep things ordered, most providers split pairs into the following categories. Major pairs. 7 currencies that make up 80% of global Forex trading. Includes Euro to US dollar to Japanese yen, Pound sterling to US dollar to Swiss franc, US dollar to Canadian dollar and Australian dollar to US dollar. Minor pairs. Less frequently traded, these often feature major currencies against each other instead of the US dollar. Includes Euro to Pound sterling, Euro to Swiss franc, Pound sterling to Japanese yen. Exotics. A major currency against one from a small or emerging economy. Includes US dollar to Polish zloty, US dollar versus Polish zloty, Pound sterling to Mexican peso, sterling versus Mexican peso, Euro to Czech koruna. Regional pairs. Pairs classified by region, such as Scandinavia or Australasia. Includes Euro to Norwegian krona, Euro versus Norwegian krona, Australian dollar to New Zealand dollar, Australian dollar versus New Zealand dollar, Australian dollar to Singapore dollar. What moves the Forex market? The Forex market is made up of currencies from all over the world, which can make exchange rate predictions difficult as there are many factors that could contribute to price movements. However, like most financial markets, Forex is primarily driven by the forces of supply and demand, and it is important to gain an understanding of the influences that drives price fluctuations here. Central banks. Supply is controlled by central banks, who can announce measures that will have a significant effect on their currency's price. Quantitative easing, for instance, involves injecting more money into an economy, and can cause its currency's price to drop. News reports. Commercial banks and other investors tend to want to put their capital into economies that have a strong outlook. So, if a positive piece of news hits the markets about a certain region, it will encourage investment and increase demand for that region's currency. Market sentiment. Market sentiment, which is often in reaction to the news, can also play a major role in driving currency prices. If traders believe that a currency is headed in a certain direction, they will trade accordingly and may convince others to follow suit, increasing or decreasing demand. Economic data. Economic data is integral to the price movements of currencies for two reasons: it gives an indication of how an economy is performing, and it offers insight into what its central bank might do next. Credit ratings. Investors will try to maximize the return they can get from a market, while minimizing their risk. So alongside interest rates and economic data, they might also look at credit ratings when deciding where to invest.